Hello, and welcome to a rapid response edition of The Commentators, an interview series by Parisi. I'm Nick Connor, and joining us again is Andrew Sangster to discuss the developments in the budget and the government's announcements on workers' rights. Andrew joined us to preview both policy areas a few weeks ago, which you can watch in full on the Parisi YouTube channel. Since then, there's been major movements which will affect the hospitality sector. Andrew is a former national news journalist with more than 3 decades experience focused on the hospitality industry. He now covers the wider operational real estate space and the growing hotelification of property asset classes. As the owner and editorial director of Hotel Analyst, the leading news analyst service for hospitality investors, he provides insights and context for decision makers across the hotel and the operational real estate space. Through Hotel Analyst, he runs the Operational Real Estate Summit and the Hotel Industry Development Event, which brings together investors, owners, financiers, advisors, and innovators to explore the deals and trends shaping the future of the sector. Welcome, Andrew.
Nick, good to be with you.
So, please update listeners on what's happened since the last time we spoke.
Well, of course, the big news is the budget, and it was generally pretty bad news from a hospitality industry perspective. I mean, we can start with the macro outlook, the impact across all industries. And I think the best description of this budget was as a Klarna budget, a buy now, pay later budget, because most of the spending that was announced is happening right away. And a lot of the tax raising is happening 2 to 3 years into the future. Now, there's a problem with this in that it creates risk and it creates uncertainty about whether the government's actually going to be able to deliver on that tax raising promise that it's made. And what this means in effect is that the government's going to be paying more to borrow. And that business is going to be in fear of further tax rises in future budgets. And there is a real fear that what we're creating here, after last year's budget, where we were promised, we're only going to have that session of tax rises, we're not going to see any more. And yet she's come back for another bite. This is the Chancellor, Rachel Reeves, for another bite in terms of extra taxes. There's a worry that we're going to see this sort of doom loop going on where the government keeps coming back, the economy keeps contracting, or at least suffering slower than otherwise it would have growth, and she keeps needing to raise taxes to pay for ever increasing spending commitments. Because if there's one thing that's clear over the past year, is that this government is not one that is going to cut spending. So that is ruled out. So it's got a choice to borrow more, which is increasingly difficult given that we've already got just about the highest borrowing costs of any major economy right now here in the UK, certainly much more than our main European rivals and the States and Canada and Australia, etc. So there's a real fear about what's going to be happening here in terms of that potential doom loop. And the second point that's worth making is in terms of just what's already happened, thanks to these 2 substantial tax rising budgets. So that first one, over £40 billion, is being sucked out of the economy. That means it's going to hurt consumer spending, particular issue for the hospitality industry where, because those tax rises disproportionately fall on those with the broadest shoulders, but it's those broad shoulders that typically spend the most money in the hospitality sector. So that's been an impact. And then she's come back again for a further 26 billion in this latest budget just 13 months later. Now we can see what's happening directly in terms of the revision to growth. It's now down at 1.5% according to the Office of Budget Responsibility. That's the forecast we've got ahead. And if we look on a per head basis, the UK is now the slowest growing economy in the group of the big 7 economies globally, the G7. So we can see just how damaging these budgets are, I think, directly in terms of the numbers and the impact on growth. Now, if we go on to...
Yeah. Yeah, well, that's interesting. So let's take it from the G7 and take it down to the high street almost, and what do you think is the effect actually going to be on UK hospitality? Away from rich people may not be sort of getting their sort of presidential suites, but if you're running a hotel, I mean, what's the nitty gritty?
Well, I guess I'd highlight three areas. Now, this is not just the budget, it's also announcements alongside the budget. So we've got the national living wage, which has gone up. The main national living wage went up with RPI. And a very sort of technical but important point is that these increases go up with retail price index, which is higher than the actual rate of inflation. So the current rate of RPI is 4.3%, whereas CPI, which is what so the target for the Bank of England is, that's currently 3.6%. So we've got this almost a percentage point extra increase above the usual measure of inflation. Things are going up by. But the worst thing from a hospitality industry perspective is that for people 18 to 20, their national living wage went up 8.5%, way above inflation. So there's sort of triple the current rate of inflation. And this has a real impact. Now, wages are the single biggest cost area for hospitality business. So this is a big hit. Now, it's not, and hospitality employs far more young people than most other sectors. So this has been a particular hit to hospitality. And it also means that employers are typically going to have to put wages up across the board because they need to maintain those differentials between the youngest and least experienced members of staff and the older members of more experienced members of staff. So we're going to see this big increase in costs in that biggest single area of cost increases, which is wages. So that's the first hit, I think, here to hospitality. The second hit is a great deal of disappointment to business rates. So there were a lot of promises from the government. We hear you, we understand what's gone on, and we want to try and rebalance with what's going on with the bricks and mortars businesses, with those online businesses and other similar businesses that don't operate out of bricks and mortar premises anywhere near the extent of hospitality. But unfortunately, these promises that were made, or at least hinted at, have not been delivered. And what we're going to end up with is a situation where business rates are going to go up. In most cases, slightly complicated because there's a few moving parts in this. But in most cases, hospitality businesses are going to face higher rates than before the COVID lockdowns. During the COVID lockdowns, business rates were cancelled, they weren't collected. Obviously, the businesses had to be shut and weren't able to trade. And then there's been this phased transitional relief, and this is going on for the next 3 years. But the government's sort of given with on one hand and taken with the other. And what they gave was they said, look, they apply this thing called multipliers in terms of there's a valuation on the businesses, and they apply a multiplier to it, and they've introduced lower rates of multipliers, but they've also, thanks to a revaluation, significantly increased the values on which those multipliers are applied. So the net effect is a higher level of business rates, which will be in effect in 3 years' time. Now, there is a period of transition in that, but UK hospitality, for example, they're talking about pubs facing on average 76% higher business rates and hotels 115% higher business rates. So it's another, this is the second area of clobbering which we saw. And
Andrew, what does this mean for either the guys you're chatting to who are running hotels or current or prospective investors into UK hospitality? What does this now mean for them? Does this change how investors go view assets in UK? Is this going to mean we're going to see more hotels shut or just going to struggle on? What do you think the short, mid, and long term effect of this budget will have on this?
well, the most basic thing is investors expect a return. So they have a choice of where they're going to invest. They have a choice whether to invest in the UK and if they do decide to invest in the UK, what sector they're going to invest in. Now, if you put up costs to the businesses, that means the return the investor will get will go down. And that means net net, the sector looks less attractive as an investment proposition. So this means we're going to see less investment in hospitality as a direct result of these changes. So, I mean, I think I will just add that third area in which we've had a specific clobbering to the hospitality sector. And this was a real broken promise by the government. 2 months ago, the tourism minister got up in the House of Commons and declared, we will not be introducing a tourism tax. And guess what they've just announced? They've announced a tourism tax. They've not actually announced what it's going to be, creating another period of uncertainty. But guesstimates are it could be as much as 5%, which is what's being levied at the moment by Edinburgh Council. And any area which has a mayor, in terms of the regional areas with these mayors, they're going to be able to levy these tourism taxes. Now, this is a complete breach of that promise we had just 2 months ago. And this is going to be quite a painful issue in terms of if you're running an accommodation business. So say it is 5%, the net impact in terms of tax now, if you go and stay in a hotel in the UK, you're going to be paying directly 26% to the government because they're levying VAT on that tourism tax. So you've got that 5% with VAT on it, taking it to 6%, and you got the 20% VAT. So this whopping great big tax hit now in terms of people staying in hotels. So we've got these three very big measures now coming into our sector. So we've got that living wage hike, we've got that hike in terms of business rates, and we've got that tourism tax hike. All of this extra tax, what does that mean? Goes back to this point, it's going to hugely increase costs for hospitality businesses, which means the net return available to investors goes down, which makes the sector look less attractive, which means net you're going to get significantly less investment. We're already seeing hospitality businesses close. We're seeing hospitality businesses shed staff, and this is just from the previous budget. And this is now further tax increases going to accelerate that decline. It's a very bad situation when we're coming into an economy which is very low levels of growth. We've already got rising unemployment. We're an entry-level employment sector. This is going to make the situation for hospitality and also the economy at large significantly worse.
Now, you're talking about an entry-level employment sector. There has been some positive news, and you tell me if it's positive or not. But from my point of view, it seems like a positive news that the government's U-turned on day one employee rights. Is that welcomed in the hospitality sector? Is it too little, too late? Is it common sense finally drawing on the government? What's your take on?
Well, we don't know if it's actually going to happen and whether actually there's going to be a backbench rebellion that they force as a U-turn, because we saw that when they attempted quite modest cuts on government spending regarding welfare, and they've pulled back on all of those. So we could well see a pullback on this. But yes, it makes sense to do. So rather than have employment rights from day one, there's now a 6-month effective probationary period which is going to be allowed. It had been 2 years, and I think 6 months is something most businesses can live with in terms of a probationary period, but it doesn't take away all the other bits which they're imposing: further risk, further costs, further difficulties in terms of having to do work for the government in terms of regulatory change, in terms of collecting extra bits of data, which we talked about in our previous podcast. They're still there. So, and we still have this extra liability, which hospitality employers are particularly vulnerable to in terms of that third-party harassment piece. None of that has been clarified, and there doesn't seem to be any changes there. So this is a modest change, which is certainly helpful, but not transformational.
Andrew, my final question is, we know Sir Keir Starmer subscribes to Parisi's The Commentator, and he's an avid listener, particularly when you're all on. So what would you say? What's your message to the Prime Minister?
I think he has to recognize where the jobs of the future are going to come from. He has to recognize that if he wants to do something about the 6.5 million people in this country who are of working age and on out of work benefits, it is hospitality more than any other sector which is capable of getting them back into work. And he should be working with us, encouraging us to employ people to help get this very profound problem for our society fixed. But he's doing the opposite right now. He needs to listen to us and see, rather than force us to be slashing jobs, he should be encouraging us to grow and enabling us to employ more people to help the overall economy.
Perfect. Thank you very much, Andrew. I've been Nick Connor, and this has been the Communicators by Parisi. If you enjoyed this episode, please give us a like and give us a comment. Tell us what you think. You could also go back to our last episode with Andrew, who was going in a bit more detail about all these issues we discussed today. So thank you very much, and we'll see you next time. Goodbye.